For decades, traditional finance theory held sway, depicting investors as perfectly rational beings driven solely by logic and efficiency. This perspective painted a picture of the market as a well-oiled machine, where every participant acted with calculated precision. This model, while elegant in its simplicity, failed to account for the messy realities of human behavior. Real-life investors often find themselves overwhelmed by the sheer volume of information and the emotional rollercoaster of market fluctuations. Enter behavioral finance, a field that acknowledges the significant role psychology plays in our financial decisions. Unlike traditional finance, behavioral finance delves into the cognitive processes and emotional responses that drive our actions in the financial markets. Behavioral finance recognizes that we are not always rational actors. Our decisions are often influenced by our emotions, leading us to make choices that defy logical analysis. Instead, we are susceptible to a range of cognitive biases and emotional influences that can lead to irrational and often detrimental investment decisions. These biases can cloud our judgment, making it difficult to stick to a well-thought-out investment strategy. This exploration delves into the fascinating world of behavioral finance. By understanding the psychological underpinnings of our financial behavior, we can begin to see the market through a new lens. We'll uncover the hidden forces shaping our financial choices by examining key concepts like mental accounting and herd behavior. Mental accounting refers to the tendency to categorize and treat money differently depending on its source or intended use, along with common biases such as confirmation bias and loss aversion. Confirmation bias leads us to seek out information that confirms our pre-existing beliefs, while loss aversion makes us more sensitive to losses than to gains. Real-world examples will illustrate how these psychological phenomena manifest in the investment landscape. For instance, during market downturns, investors often panic and sell off assets, exacerbating the decline. Importantly, we'll also equip you with practical strategies to mitigate the impact of these biases. Techniques such as setting clear investment goals, maintaining a diversified portfolio, and practicing mindfulness can help you stay grounded, empowering you to make more informed and rational investment decisions. By being aware of our biases, we can take steps to counteract them and make decisions that align with our long-term financial objectives. Understanding behavioral finance is not just an academic exercise, it's a practical tool that can enhance your investment strategy and improve your financial well-being. It's about gaining a deeper understanding of ourselves as investors. By recognizing our inherent biases, we can develop strategies to overcome them, leading to more disciplined and effective investment practices. By recognizing our inherent biases, we can develop strategies to overcome them. This self-awareness is the first step towards making more rational decisions in the face of market volatility, paving the way for sounder financial decision-making and ultimately greater long-term investment success. With the right knowledge and tools, you can navigate the complexities of the market with confidence and achieve your financial goals. Imagine dividing your money into separate mental accounts, one for everyday expenses, another for long-term savings, and yet another for entertainment. This mental division helps us organize our finances and prioritize our spending. This is the essence of mental accounting, a cognitive bias where we categorize and treat money differently based on its source or intended use. By doing so, we create a sense of control and order in our financial lives. While seemingly harmless, mental accounting can have profound implications for our investment decisions. It can influence how we perceive risk and reward, often leading us to make choices that may not align with our overall financial goals. For example, we might be more willing to take risks with easy come, easy go money, like an unexpected bonus or gambling winnings. This money feels less earned, and thus we might treat it as disposable, ready to be risked on high-stakes investments or impulsive purchases. Conversely, we may be overly conservative with money earned through hard work, even if a bolder investment strategy aligns better with our long-term goals. This cautious approach can stem from the emotional value we attach to hard-earned money. making us reluctant to expose it to potential loss. This disconnect between our mental accounts can lead to suboptimal asset allocation and hinder our ability to maximize returns. By treating different pools of money with varying degrees of risk tolerance, we might miss out on opportunities for growth and diversification. Consider a scenario where an investor has a portion of their portfolio earmarked for their child's college education. The emotional weight of this goal can lead to overly cautious investment choices. Despite having a long time horizon, they might shy away from growth-oriented investments, opting instead for perceived safer options due to the mental account they've assigned to those funds. This conservative approach, while seemingly prudent, may not keep pace with inflation or the rising costs of education, ultimately falling short of the intended financial goal. To counteract the effects of mental accounting, it's crucial to adopt a holistic view of your finances. By integrating all your financial goals and resources into a comprehensive plan, you can make more informed decisions that align with your overall objectives. Embracing a diversified investment strategy and regularly reviewing your portfolio can help ensure that your money is working effectively towards your long-term goals, regardless of its source or initial purpose. The stock market is often described as a herd of bulls and bears, and for good reason. The imagery of bulls and bears captures the essence of market dynamics, where optimism and pessimism constantly clash. Herd behavior, the tendency to follow the actions of the crowd, is a powerful force in the investment world. This behavior is not just limited to the stock market, it can be observed in various aspects of life, from fashion trends to social media fads. When everyone is buying a particular stock or asset class, it can create a fear of missing out, FOMO, that drives prices ever higher, leading to a market bubble. This FOMO can be so intense that it clouds judgment, making investors overlook fundamental analysis and intrinsic value. Conversely, when panic sets in and everyone rushes for the exits, it can trigger a market crash. The speed at which sentiment can change is astonishing, turning euphoria into despair almost overnight. The dot-com bubble of the late 1990s is a prime example of herd behavior in action. During this period, the promise of the internet led to speculative investments in tech companies, many of which had no viable business models. Investors caught up in the hype surrounding internet companies poured money into tech stocks, driving valuations to unsustainable levels. The excitement was palpable, with media and analysts often fueling the frenzy. When the bubble inevitably burst, countless investors suffered significant losses. The aftermath was a sobering reminder of the dangers of speculative mania and the importance of due diligence. Herd behavior often stems from our innate desire to conform and our aversion to standing out from the crowd. This psychological tendency can be traced back to our evolutionary past, where being part of a group was essential for survival. However, in the investment realm, blindly following the herd can be a recipe for disaster. Independent thinking and critical analysis are crucial to navigating the complexities of the market. It's crucial to base investment decisions on sound analysis and a well-defined investment strategy, not on the whims of the masses. By doing so, investors can mitigate risks and make more informed choices, ultimately leading to better financial outcomes. Section 4. The emotional gap. When fear and greed take the wheel, investing is not solely a game of numbers, it's also a game of emotions. The emotional gap refers to the chasm that often exists between our rational understanding of the market and our emotional responses to it. Fear and greed, two of the most powerful emotions, can cloud our judgment and lead to costly mistakes. When markets are soaring, greed can tempt us to chase returns, leading to impulsive decisions and overpaying for assets. Conversely, when markets tumble, fear can paralyze us, causing us to sell at the worst possible time and lock in losses. Imagine an investor who panics and sells all their stock holdings after a market downturn, only to miss out on the subsequent rebound. Fear dictated their actions, not a rational assessment of the situation. Section 5. Anchoring the peril of first impressions in investing. Anchoring bias describes our tendency to rely too heavily on the first piece of information we receive on a topic, even if it's irrelevant or outdated. In investing, this could manifest as fixating on the price at which we first bought a stock. If the stock price falls below our purchase price, we might hold on to it, hoping it will rebound to our anchor price, even if the fundamentals of the company have deteriorated. For example, imagine an investor who bought a stock at $100 per share. The stock price subsequently drops to $50. Due to anchoring bias, the investor might refuse to sell, clinging to the belief that the stock is worth $100, even if there's no rational reason to expect it to return to that level. Anchoring can prevent us from making objective investment decisions. It's crucial to evaluate investments based on their current merits, not on past prices or arbitrary benchmarks. Section 6. Self-attribution, claiming victories, blaming losses. Self-attribution bias is our inclination to attribute our successes to our skill and our failures to external factors. In the context of investing, this can lead to an inflated sense of our own abilities. We might credit a winning trade to our market savvy, while blaming a losing trade on bad luck or unforeseen circumstances. This bias can be particularly dangerous as it can lead to overconfidence and excessive risk-taking. If we believe our successes are entirely due to our brilliance, we're more likely to make reckless bets, assuming our winning streak will continue. Imagine an investor who experiences a string of successful trades. Fueled by self-attribution bias, they might become overconfident and increase their position sizes, only to suffer heavy losses when the market inevitably turns against them.